back to Wealth Wise Mindset. I'm Sean, and here we break down personal finance and investing so you can build real wealth wisely without the noise. Today, we're tackling a question that confuses a lot of beginner and even intermediate investors. Should I invest in ETFs or index funds? They sound similar. They both offer diversification. They're both low cost. So what's the difference? And more importantly, which one is better for long-term wealth building? Let's break it down. What are ETFs and index funds? First, let's define both terms in plain English. An index fund is a type of mutual fund that tracks a specific market index, like the S&P 500. It pulls money from investors and buys all the companies in that index. It's passive investing. No one's trying to beat the market, just match it. An ETF, or exchange traded fund, can also track an index, and often does. In fact, many ETFs are index funds in disguise. The key difference? ETFs trade on the stock market just like a stock. You can buy and sell them throughout the day. So, both can track the same index, both offer diversification, both are low cost and passive, but how they're structured and traded makes the difference. Let's get into that. Here are the major differences you need to know. Trading flexibility. ETFs trade like stocks, meaning you can buy or sell them anytime the market is open. Index funds only trade once a day at the market's closing price. If you like the idea of trading during the day or setting limit orders, ETFs give you that flexibility. But for long-term investors, it usually doesn't matter. Number two, minimum investment. Index funds often have minimums, sometimes $1,000 or more. ETFs can be bought with the price of a single share, or even less if your broker offers fractional shares. Winner here, ETFs, especially for beginners, starting with small amounts. Number three, tax efficiency. ETFs are generally more tax efficient thanks to something called the in-kind redemption process. Index funds can trigger capital gains distributions more often. If you're investing in a taxable account, not an IRA or 401k, ETFs usually have a slight edge. Number four, automatic investing. With index funds, it's easy to set up automatic investments directly through brokers like Vanguard or Fidelity. With ETFs, you can automate, but it depends on your platform. Some brokers don't support recurring ETF purchases, or they might only allow it with fractional shares. So if you're all about set it and forget it, index funds are often simpler to automate. Similarities that matter. Now here's what really matters, the similarities. Because for long-term wealth, these are key. Diversification. Both ETFs and index funds give you exposure to hundreds or thousands of companies in one purchase. Low fees. Both typically charge expense ratios under 0.10%. That means more of your money stays invested. Passive strategy. Both follow a buy the whole market approach. You're not betting on individual companies. In other words, both are excellent tools for long-term investing. So now the big question, which is better for long-term wealth? So which one should you choose? Here's the truth. For most long-term investors, the difference is small. Both ETFs and index funds can help you build serious wealth over time. But here's a cheat sheet. Choose ETFs if you're investing in a taxable account, you want low minimums and trading flexibility, you prefer using apps like Robinhood, Webull, SoFi, or Public. Choose index funds if you're investing in a retirement account like a Roth IRA or 401k. You want easy automation with brokers like Vanguard or Fidelity. You don't care about intraday trading and want something truly hands-off. In the end, it's less about which is better and more about which fits your system and style. Historical performance and behavior matters. Before we compare investors, let's zoom out for a moment. Historically, both ETF and index funds tracking the same index, like the S&P 500 or total market, have delivered nearly identical returns because they're based on the same underlying assets. So what really drives your success as an investor? Your behavior. Did you keep investing during market dips? Did you avoid panic selling? Did you stay consistent year after year? Studies show that investor behavior, not fund choice, is often the biggest factor in long-term results. So while choosing between ETFs and index funds does matter, what matters more is having a strategy you can actually stick with, especially when the market gets rough. Now let's look at the two investors using different paths to wealth. Scenario here of two investors compared. Let's compare two long-term investors. Investor A, Emily, invests $300 a month into VTI, an ETF that tracks the total US stock market, uses a taxable account on Robinhood, reinvests dividends, keeps her investing costs near zero. Investor B, Daniel, invests $300 a month into VTSAX, a total market index fund, uses a Roth IRA on Vanguard, automatically invests every month, also pays near zero fees. Fast forward 30 years. They'll both likely end up in the same ballpark, assuming similar returns and consistent contributions. So the best choice? The one you'll actually stick with. Common mistakes to avoid. Whichever you choose, avoid these mistakes. Number one, overcomplicating it. Don't try to own 20 ETFs and funds that overlap. One or two broad market funds is often enough. Number two, focusing too much on fees. Yes, fees matter, but don't stress about a 0.03% versus 0.04% expense ratio. That's pennies. Number three, switching back and forth. Pick a strategy and stick to it. Switching constantly can trigger taxes and derail your plan. So ETFs versus index funds, what's the verdict? Both are powerful tools for building long-term wealth. The key is to choose one, start investing consistently, and stay the course. Don't get caught up in tiny differences. The discipline to invest regularly matters more than the product you choose. Now I want to hear from you. Are you team ETF or team index fund? Or are you still figuring it out? Drop a comment below. I'll read every one. If this video helped clarify things, give it a thumbs up and subscribe to Wealthwise Mindset for more no fluff investing guidance every week. Until next time, stay consistent, stay focused, and as always, grow your wealth wisely.